Well, welcome everyone. This is Kaplan's free webinar on economics and taxation. Thank you for joining us today on this webinar, which will be 1 hour in length. And my name is Marie Sykowski, and I have been with Kaplan for about 21 years now, teaching a variety of securities classes. And just as a reminder for you that these webinars are meant to be an introduction to the various topics that we've been covering over the past few weeks, and these are topics that are pertinent to all the different exams. So we have many of you on these calls, and you're all taking different exams, but the content that we're covering is relevant to all of them. But please understand that the test will expect much more from you than what you'll be learning here in these webinars. So this is just meant to give you a bit of a foundation to get you started and get you on your way as you continue your studies. So let's go ahead and begin. We're going to get started with today's topic, again, economics and taxation, a very large and important topic. Economics is about supply and demand, and how that supply and demand affects jobs, wages, manufacturing, banking, as well as many other areas of our lives. And since interest rates is just one of the tools used to keep the economy humming along, you do need to have a basic understanding of economic principles so that you can anticipate how your clients' investments could be impacted, or just to know which types of investments would be most suitable for the client given the economic outlook. So economics and taxation are two areas that are intertwined with suitability. And suitability, as you all know, is a big part of all of these exams. Okay, so I'm just giving you an overview at this point, so don't be concerned if you're not seeing the slides moving. Just giving you a broad overview, big picture of where we're going to be going. So you don't need to be an economist or an accountant, and you certainly don't want to get overly analytical with any of these concepts. So if you do have a background in finance or an accounting background, anything of that nature, just remember this is a all of these exams are very high level. So please do not get over analytical with these exams. None of these exams, none of the questions, I should say, are meant to be analyzed. So it's all about keywords, finding those keywords and word association, matching them up, picking your answer and moving on. The less actually you get bogged down in thinking, the better off you will be. So remember just to answer what they are asking. Okay, again, look for the keywords provided, pick the best answer. You don't have to agree with it, just pick what they want. And also remember, please remember that this is not a real world exam. So don't think of the real world. Don't think of what you might actually do in a real world situation. It's just all about matching key words. Okay? All right. So we're going to go ahead and talk about what we're going to be touching on in this webinar. And after this webinar, you should be able to hopefully understand what does influence the economy, define the two types of financial statements, recognize the tax consequences associated with different types of investment products. So the economy, as I mentioned, is driven by supply and demand. Once again, giving you just a big picture overview here before I flip the slides for you. And that supply and demand for goods and services goes through cycles. So you'll absolutely want to know about the 4 phases of the business cycle, okay? And knowing where the economy is at within this cycle can help you to anticipate where the economy might be headed, and it also gives you an idea of where interest rates might be headed. And the movement of interest rates, of course, has implications for bonds as well as stocks. So let's talk about these 4 phases here. We've got expansion, which we can also think of as growth. So when the economy is growing or expanding, we would call that expansion. Okay, we watch for signals that the economy is peaking or hit its peak in prosperity, and then we know what goes up must come down. So the next phase would be the decline or the contraction phase. And then we look for the bottom to form. Technically, that's known as the trough. Often in the news, you would just hear them say, we're looking for a bottom to be put in, but for test purposes, you want to know the word trough. And then the trough signals that the cycle is set to repeat. And they do just call that recovery. So sometimes people look at this and say, well, isn't that 5 phases? Well, no, it's really 4 phases, because recovery and expansion are really the same thing. So expansion, recovery, again, the cycle just starts all over again. And as it starts all over again, the economy goes through these 4 phases in order. There's no way you can go from expansion directly into decline without touching the peak, right? You can't go from decline to recovery without going through the trough phase of the cycle. So you need to know the phases, and you need to know the order of the phases. So how do we know where the economy is at in this cycle? How do I know when it's about to turn and change directions? Well, that's a good question, and that's what economists and analysts and market watchers are paying attention to. And there are numerous indicators that economists and analysts and traders watch and pay attention to. We're just going to be talking about one of them here, and that is GDP. And we'll define GDP, which stands for Gross Domestic Product. We will talk about that on the next slide. And GDP is really, though, just going to be a measure of everything that is produced here in the U.S. So when we're producing more here, that is in response to demand. So when there's demand for goods and services, we produce more. And as long as we're producing more, that will drive GDP up. And as long as GDP is positive, the economy is said to be expanding. All right, now we will watch for GDP as it's growing. We will watch for it to hit a peak, flatten out and peak. And then we know what should come next is the decline phase. GDP should go negative. And we'll talk about when you have negative GDP. There's some definitions you'll need to know there. But negative GDP implies that the economy is in the decline or the contraction phase. Again, we monitor that, watch for that trough to form, and we know eventually the GDP, when it starts to rise, that will signal the recovery. All right. So again, GDP, the very important number, one that is very widely paid attention to, along with other indicators. But we're just going to be, like I said, talking or touching on GDP for this particular webinar. Now, growth, of course, is good. We like to see the economy growing and expanding, but actually, they don't want the economy growing too quickly. And when I say they, that's going to be those that set both our monetary and fiscal policy, which we're going to talk about. So the goal of both monetary and fiscal policy is to keep the economy growing at a steady and comfortable pace. They don't like to see it get too overheated, meaning they don't want to see it growing too quickly, because when the economy becomes overheated, that is what can be defined as inflation. So inflation is when the growth is happening too quickly. Okay, and if demand can't keep up to meet supply, then what happens is prices start to rise, right? And that's the definition of inflation. So really what's driving, understanding, what's driving inflation is demand for goods and services. And we'll get into this a little bit more, but how all these pieces fit together. If you think about it, again, think about how these pieces fit together. GDP represents production. Okay, the only reason we're producing more is because there's demand. And what do people have in their pockets that would be driving demand? They have money. So money, how much money is available and floating through the system is a key component that is driving demand or not. In times when the economy is declining, then the problem there is there's not enough money floating through the economy. So the keepers of policy, monetary and fiscal policy, will be looking for ways to stimulate demand during periods of decline or contraction. Okay, we're going to get into that, like I said, the different types of policy. All right, so GDP, we've been talking about that. Now, GDP, gross domestic product, means domestic, so items that are made here in the USA, goods and services produced here in the USA. It is a quarterly number, and it is a number that measures not just goods made by U.S. companies. It is goods made by any company here in the U.S. So, for instance, Toyota has several manufacturing plants here in the U.S., one of those being in Texas. And so it's a Japanese company with a plant here in the U.S. Why would those trucks that the Japanese company is making, why would they be part of the U.S. GDP? Well, because those plants here in the U.S. Are employing U.S. workers. And when they get their paychecks, they are putting that money back into the U.S. economy. So GDP looks at all goods and services made in the USA. Just think of it that way. GDP means made in the USA, American or foreign company, it doesn't matter. All right, GDP is reported on a quarterly basis, and we just talked about looking and watching at the GDP number to give us signals and clues about where the economy is at in that business cycle. As GDP is rising, then we say that the economy is expanding, but when GDP declines, I mentioned that that is also a number that we pay close attention to. If we get negative GDP for 2 consecutive quarters, now remember, 1 quarter is 3 months. So 2 quarters would be 6 months, and they can express that either 2 quarters or 6 months. So you have to read very carefully and be careful, that you don't just gloss over something. Often we've learned something perhaps in a certain order, or we've learned to look for maybe certain little triggers that our eyes pick up on, and it tends to cause us not to read as closely as we should. And it's easy to make careless errors because of that. So read very carefully. 2 quarters is the same thing as 6 months. If you have 2 consecutive quarters or 6 consecutive months of negative GDP, then that's what would be defined as a recession. If it goes on for longer than that, you've got 6 consecutive quarters of continuous declining GDP, that would be 18 months. That would be a bit depressing, right? So recession versus depression, those are 2 definitions that you should definitely be familiar with. All right, so we measure GDP as a measure of goods and services that are being produced here in the U.S. But as we look at the goods and services being produced, we're looking at the value of those goods and services. And the value of those goods and services over time, just naturally, prices are going to inflate. There's always some inflation present in the economy. The purpose of monetary and fiscal policy is to keep inflation at what they consider to be a healthy pace, which is typically about 2% is about where they like to keep inflation. If it gets more than that, then they feel that that can lead to problems with inflation. If it's less than that, they might look for ways to stimulate a bit, but they try and keep it around 2%. So you're going to have inflation happening naturally over time. So when they're measuring these goods and services, they're looking at, if you will, a basket of goods, and I have the basket of goods. I'll touch on all of these other terms here. But so you have this basket of goods, and if we're looking at how much inflation is present in the economy, they have to factor out the amount of inflation that might be skewing the number. So they measure inflation through something called the CPI, the Consumer Price Index. So the CPI is a measure of inflation. And when they use CPI to factor out, if you will, the amount of inflation present in the prices of those goods and services, they're measuring those goods and services in what are called constant dollars. So constant dollars, it's just a term that simply means we're measuring with dollars that have been adjusted for inflation. We're keeping them constant. $1's worth of goods last quarter or a year ago when we measured that same basket of goods, what $1 represented then is what $1 represents today. We factored out the inflation. So constant dollars, Constant dollar risk, you might sometimes see that, constant dollar risk. That's just another way of saying inflationary risk, right? So CPI and inflation are one and the same thing. Now, we know that inflation has an impact, of course, on the value of goods and services. So we have this basket of groceries here, and we know that over time, again, that the value of or the cost of those goods and services is going to inflate over time. So that's what's known as purchasing power risk. And purchasing power risk, again, another way of saying inflationary risk. Okay, it's the risk that your dollar today will not buy you as much in the future. So for someone who is worried about inflation, worried about losing their purchasing power from a suitability standpoint, you would not want to recommend any type of fixed investment, right? Because you're locking them into a fixed amount of income. Okay, and people need growth if they're worried about inflation. All right, so CPI, as we just mentioned, what does CPI measure? Well, it measures prices. When prices are rising, we define that as inflation. It's a little roller coaster there, going up, up, up. Prices rising, that's inflation. And then they come down on the other side. And you can see at the far right of this roller coaster, the deflation kind of going up a cliff there. So that's pretty steep deflation, but prices falling. And also think a lot of times people like to think of a balloon. You blow the balloon up and it inflates. That would represent inflation, prices rising. You deflate the balloon and it falls to the ground, it collapses, prices are falling. These are just definitions. And then there's one other definition that you just want to be, again, familiar with it from a definitional standpoint. They're not going to get into, again, economic, heavy-duty economic discussion here about what causes stagflation. You just want to know what it represents. Stag, the word stag, standing for or representing stagnant economy. You see the little sign on the roller coaster, the middle phase there, where right here, okay, stagflation. So the roller coaster would be going flat. There's little to no growth during periods of stagflation. So normally, if the economy was flat or stagnant, we wouldn't expect prices to be rising. Remember, for prices to be rising, there needs to be demand. And generally, to have demand, people need money. Well, during a flat or stagnant economy, actually, you would have periods of high unemployment during this time. So money would be tight. People wouldn't have as much to spend. So you would think the prices would be going down. But stagflation is the combination of a stagnant economy, but yet you still have rising prices happening during this time. So again, just a definition. So stagnant, inflation for inflation, stagflation, stagnant economy, rising prices. Okay, so inflation, stagflation, deflation. All right, so we were talking about different types of policy. And I mentioned two types of policy, monetary and fiscal policy. So the first influence on the economy we're talking about here is the monetary policy. So monetary policy, you want to know with these two types of policy, who sets which type of policy, and some of the keywords that you would associate with the different types of policy. So this first one here, monetary, if you look at it, monetary, okay, looks very similar to the word money, and that'll clue you in as to who sets the monetary policy. And if it looks like money, that's going to be your bank. Bank being the Federal Reserve System. And here you can see some of the things that the Fed is responsible for. We're not going to go over all of these here in our discussion. We're going to focus on this one right here, talking about how the Fed, or what they might call the FRB, they might just call the Fed, the Federal Reserve Board, the central bank, right? The Fed is our central bank. And we're going to talk about how they manage inflation. So that you understand inflation, what's driving inflation is demand, right? Demand, more demand than there is supply. That's what causes prices to rise. And again, going back to what drives demand? Money. So where's the money supply kept and controlled? It's controlled by the Federal Reserve. so the money supply, when we talk about the money supply, that is going to be the domain of the Fed. Okay. All right. So my little pointer here. Let's talk about how they manage inflation. So the Fed has three tools that they manage inflation with. Okay, and so the three tools of the Federal Reserve. Okay, well, the first one, which is the most frequently used tool, is something called open market operations. Open market operations, and this has to do with the actual putting money into the money supply or taking money out of the money supply through what are called open market operations. And these are conducted by a committee known as the Federal Open Market Committee, or FOMC. Again, that's Federal Open Market Committee, FOMC. And so the FOMC is made up of heads of the regional banks. That's what makes up the Federal Open Market Committee. And so the heads of these regional banks, part of the Federal Reserve System, meet, and they meet very frequently, between every 6 to 8 weeks. Roughly, they get together and take a look at what's happening in the economy. Is it moving the way they want it to move? Is inflation in check? Is there enough demand for goods and services? Is the economy growing? Okay, remember, GDP is a measure of health in the economy. So, if you will, the lifeblood of the economy is the availability of money. Okay, and that is controlled by the Fed. So they get a pulse on the economy to see if they need to put more money in. Do they need to take money out? Right. So putting money in, taking money out. The term stimulating or tightening, right, or easing or tightening the money supply. Those would be terms that we'll mention as well, okay? And so this is the tool that's used the most, and they engage in these open market operations through the buying and selling of Treasury bills, okay? So the buying and selling of Treasury bills. So I usually just have my students say, you want to just think about yourself. If you think about yourself when you buy something or when you sell something, then that hopefully will help you have a grasp of is money going into the money supply or is money coming out of the money supply? And then that'll give you a clue about what you could expect to happen with interest rates. So let's say that the FOMC announced that they were going to begin buying Treasury bills, okay? They announced they're going to begin buying T-bills. So think about yourself, right? When you last went out and bought something, maybe you went out and bought dinner last night, or you just came back from buying lunch, okay? When you buy something, okay, money comes out of your pocket, out of your wallet, and it goes into the cash register. And now that money's part of the money supply. So when the Fed is buying, just think of the same thing. If they're buying, think of them as buying lunch. They're open their wallet, okay, or easing the purse strings, and they're putting money into the money supply. So there's more money available in the banking system. So if you were to go to a bank and needed to borrow money, maybe to buy a house, or you were going to start a small business, take out a small business loan, if there's more money available, the cost of that money will be cheaper. So when there's more money available, when the Fed is easing, then the impact will be that we would expect interest rates to go down. Okay, so when the Fed is buying T-bills, they're putting money into the cash register, easing open their wallet, putting money into the money supply. More money available means interest rates will come down. Okay. On the other hand, if they are selling T-bills, okay, think of when you sell something. You've got, let's say you have a car, and you were going to sell your car. You sell your car, and you sell your car for $2,000, and someone gives you cash. You hold that cash tightly in your hand. You hold the cash tight in your hand. That's not going into the money supply. That's going into your pocket. Okay. And so it's not part of the money supply any longer. So when the Fed is selling, they're holding that money tightly. They're not making it available in the money supply. And that means there's less money available in the bank. So you go to the bank, you look to borrow money, there's not as much available. That money is going to cost you more. So interest rates here would be going up. Okay, so selling T-bills, you sell something, you get the money, you hold it tightly in your fist. It's no longer part of the money supply. Interest rates will go up. The Fed is going to do this when they're trying to slow down the money supply, right? If money's more expensive, it's less likely that you're going to go and borrow. If money's more expensive, interest rates are higher, it's less likely that, it's going to cost, let's say, cost corporations more to borrow money if they have to issue debt. So coupons will be higher. So this is going to drive interest rates across the board up when the Fed is selling T-bills, when they're tightening. But when they're trying to stimulate demand, ease the purse strings open, make more money available, let's drive interest rates down, make money cheap or cheaper so that people will be incentivized to borrow it and put it to work in the economy. Okay, so that's how you want to think of that. I would definitely understand buying and selling of T-bills, which one has to do with easing, which one has to do with tightening, and the impact that would have, that those actions have on interest rates. Now, as far as interest rates are concerned, the only interest rate that the Fed actually sets is the discount rate. They do not set the Fed funds rate. So even though that one's got the word Fed in it, it has nothing to do with the Federal Reserve Board. The discount rate is the only one that they set. It is the rate that the Fed charges its member banks if those member banks needed to borrow money themselves for operational purposes, or if they were in trouble, they can borrow from the Fed. Generally, it's not a good sign when you see a bank borrowing from the Federal Reserve at the discount window, as it's called. That generally does signal that they're in trouble. But the Fed is a lender of last resort, if you will. This rate does not change often, and as I mentioned, it does serve as the base rate for all the other interest rates that you learn about through the course of your studies. And then the third tool that we have is the reserve requirement. The reserve requirement is the amount of money that banks are required to keep on reserve. So when you deposit money into the bank, your paycheck, savings, just monies you put into the bank, as you know, the bank doesn't hold your money. They take that money and they turn right around and lend it out, put it back into the money supply. But they cannot lend out all of it. They're required to keep some of it on reserve. And that is the purpose of the reserve requirement. So if the Fed wants to slow down the flow of money, if they want to tighten things up, then they will raise the reserve requirement. That will take money out of the money supply. If they want to stimulate, we want to put more money in. So lower the reserve requirement. That will put more money into the money supply. As you can see, this is the tool, least used tool. This one would only be used if the others were not working. Generally, when the Fed is trying to have an impact on the money supply, they want to see an immediate impact. The reserve requirement takes a while for that impact to work its way through the money supply and through the economy. So that's why it is said to have a multiplier effect. It's like throwing a rock into a pond, and if it's a really big pond, then it could take quite a while for those ripples to reach the shore. So they like to see a more immediate impact. So reserve requirement will be the tool of last resort. But those are your three tools for the Fed. You want to be familiar with all three of those. Monetary policy. Okay. And monetary policy, I should say as well, this is something, because the Fed meets, like I said, about every 6 to 8 weeks, this is policy that definitely has a very immediate impact, or can have an immediate impact on the money supply, versus the other type of policy, fiscal policy, which is the domain of Congress and the president. They also can influence policy, but they set what's called fiscal policy. And fiscal policy set by Congress and the president. So what can they do that will impact how much money is or is not floating through the economy? Well, Congress is the one that writes our tax code, and sets tax rates, and also controls the amount of money that the government spends, the budget and government spending, right? That's the domain of both Congress and the president. So the tax and spend philosophy. So you want to associate tax and spend with fiscal, just like you were associating with your monetary policy. If I go back here, the main thing to associate there, interest rates, is the tool of ultimately, I should have said what the Fed is looking to influence are interest rates there. With those tools, they're trying to drive interest rates up or down. But interest rates goes with monetary policy. Tax and spend goes with your fiscal policy. All right, so as far as fiscal policy is concerned, there's two major types of fiscal policy or fiscal policy theories that we're going to cover here. And depending on, how involved you think the government should or should not be, that will define whether you subscribe to what are called demand side economics, which would say if you subscribe to demand side economics, we might describe you as someone who's referred to as a Keynesian. So you see that word there, Keynesian, demand side economics. So you want to associate this word with demand side. Okay, again, don't have to know detail. You're just associating. If you see Keynesian or Keynesian theory, demand side economics, you're going to put those together. And with demand side economics say that the best way to stimulate the economy is to give mom and pop more money. Okay, give them surplus, give them extra cash, and let them put it into the economy and buy things, and that will stimulate demand. Okay, so by lowering taxes and increasing spending, think of what that'll do. You lower taxes, it gives mom and pop more money. Increase federal spending, that certainly puts more money into the economy. So lowering taxes and increasing federal spending would encourage economic activity. If the fiscal policy was aimed at raising taxes, so we pay more taxes, we don't have as much to spend, and decreasing federal spending, cutting back on what the government is spending, think about what that would do. That's going to slow down economic activity. There won't be as much flowing through the economy, right? So demand side, give it to mom and pop and let them stimulate demand. Now, the other fiscal policy theory is supply side. Supply siders say, no, you know what? Let's not give it to mom and pop. Let's give it to corporations and wealthy people, okay? And let's let it trickle down to the moms and pops. So this is, if you've heard trickle-down theory or trickle-down economics, if you see that, you're going to associate that with supply side. It was called Reaganomics in the time of Reagan when he was in office, big proponent of supply side economics. So Reaganomics, trickle-down, and something called the Laffer curve. You're just going to associate these terms with supply side. What does it mean? Cut tax rates for corporations so that they have more money, and deregulate the industries, so deregulation, corporate tax cuts, and again, give money to the wealthiest people and let it trickle down. All right, so the value of the dollar is also something that we pay attention to. So the exchange rate, is the dollar strong, is the dollar weak compared to other currency. So here we have a little visual of the dollar here running a race with the euro, right? And so kind of a funny little picture, but it actually can help you if you struggle with strengthening, weakening. Will I get more? Will I get less? Or which one will I get more of as far as currency is concerned? So if you think of this race, think of if you were running a race. Here's our dollar. I'll put the values in there. So you see the euro is at 0.92 and the dollar is $1 even. And that's because the dollar is weak. So what this means, if the dollar is weak, think of it if you were running a race. So here the dollar is weak, it's lagging behind. So it's going to take more effort, more energy for it to catch up to that euro. That euro is crossing the finish line ahead of the dollar faster. So its time is going to be better. It's going to take the dollar more effort to catch up. So what this means is for every $1, if you gave me $1, let's say you were going to Europe, and when you get to Europe, you're going to exchange $1 for euros. Well, when you exchange $1, you're not going to get $1's worth of euros. You're going to get, let's call it 92 cents worth of euro, okay, because the dollar is weak. So if you're on vacation, you don't want to have a weak dollar, okay? So what that's going to do, you're going to have to spend more dollars to buy goods in Europe. So if you think about the economy here in the U.S., if we're importing goods into the U.S. from foreign countries, those goods are going to be more expensive for us here. So imports will decrease because the idea being that demand for imports will go down, okay? But if you're a U.S. exporter, the cost of U.S. goods overseas is going to decrease. That's actually good. If you're an exporter, a U.S. exporter, you want the dollar to be weak because your goods will be cheaper overseas and demand for exports will increase. Okay, so a weak dollar means a lower cost for U.S. exports. So just remember that exporters in any country, exporters always want their home currency to be weak, right? So if you're an exporter, on the business side, exporters want their home currency to be weak because that will increase demand, and that means that will drive profits up. Now, if and we'll get into this when exports, so here we would have more exports going out than imports coming in. So our exports would be greater than imports, and we will end up with a trade surplus. So we're going to see that in just a moment. Now, just the opposite, here we have the strong, mighty dollar. Okay, strong, mighty dollar, the dollar is strengthening. Or if you think of that race visual, here the dollar would be winning the race, right? So the dollar would be crossing the finish line first, other currency behind it. Let's say the euro was lagging behind it. So here, if you were on vacation and you cashed in $1, since it's winning the race, remember the euro would have to catch up. You're going to get more euro for your $1. So your dollar will actually go further when it's stronger. So if you were on vacation in Europe, cost of goods there in Europe would be cheaper. And here in the U.S., if we're importing goods, imported goods will be cheaper. So cost of imported goods is going to go down. Your dollar is going to buy more. Okay, so imports would increase. But remember, if you're an exporter, you don't want to see a strong dollar. Exporters want their home currency to be weak. So this is going to translate into the cost of U.S. goods being more expensive. So cost of goods in foreign markets will go up and demand will go down, okay, because they are more expensive. Okay, so when we have more imports than exports, that's going to result in a trade deficit. Okay, so to summarize surplus and deficit, surplus is when you have, and I have a little scale here for you, when you have more money coming in than going out. Then you have a surplus, so your exports are greater than your imports. More money coming into the U.S. will increase the money supply, and that grows the economy. But when we have more imports than exports, you have more going out than you have coming in. More money leaves the U.S. Imports, goods come in, money goes out. That means the money supply will go down, not as much money available. The economy will slow. All right, so we've seen how to look at ways that you can monitor where the economy is at, kind of take the health of the economy as a whole. But now if you were actually then analyzing specific companies, right? So the idea, if you're doing analysis, top-down analysis as it's called, then you start with looking at the big picture. Where is the economy at? If you were analyzing or getting ready to put together a portfolio or make recommendations for a client, you start with the big picture. Where is the economy at? And then you would look at specific companies. And when looking at specific companies to evaluate what kind of health they're in, then you want to get a hold of financial statements, and those being a balance sheet and an income statement. So balance sheet and an income statement, again, I'm going to bring this up here, but I don't want you to get concerned when you see it. But let's just define here balance sheet. So this is XYZ Corporation. And you'll notice first off that a balance sheet, it says as of December 31. So this is like taking, the saying be that a balance sheet is like taking a snapshot in time. So I want to see what does XYZ, or what did they own as of December 31st? What did they owe as of December 31st? And what was their net worth? I want to know, what is this company worth? Okay, that's what the balance sheet tells you. What is this company worth? What is its valuation? Okay, and so the term net worth is a good term to associate with the balance sheet. Net worth, it's also known as owner's equity. It could be called shareholders' equity, right? It represents ownership. So net worth, ownership. So you understand the word ownership and equity, shareholders' equity, owner's equity. So again, you do not have to be an accountant. They're not going to give you very scary questions having to do with the balance sheet. I will say that you may have some formulas that you might need to know. You might have some calculations, depends on which exam you're going to be taking. Some of them might be a little more heavy on calculations with regards to the balance sheet. So certainly if you're doing the 65 or 66, the Series 7, those tend to have a few calculations that you'll need here. Even the SIE, you might see a couple, but not as many as you might with the 7, the 65, or 66. All right, so you can familiarize yourself with the balance sheet if you're not already familiar with this. Your books or materials, whoever's materials you are using, I'm sure will guide you as to some of the formulas that you need to know here. We're not going to get into that with our little 1-hour session here today. But you have assets, which I want you to notice. What you do need to know is the basic balance sheet equation. If you take the assets, total assets, which comes from the total current plus the total fixed, added together, total assets. Over here, liabilities is everything the company owes. Current liabilities, what they owe in the next 12 months. This is long-term debt altogether. Total liabilities here, 46.5. Take the assets, subtract the liabilities, and that leaves you what's called net worth. Okay, so assets minus liabilities equals net worth is one way it can be written, or we can say net worth plus the liabilities, or liabilities plus net worth. Those two added together should equal your assets. Okay, so definitely balance sheet equation. I would be familiar with that across the board with all exams. Okay, the other financial statement that you want to know about is going to be what's called the income statement, or the P&L. Income statement, or the P&L. Profit and loss. So this tells you whether or not this company is making any money, right? And that's what we want to know. If I'm an owner in a company or thinking about investing and becoming an owner in a company, I want to know, are they making money or not? So the financial statement, the P&L, the income statement, or the P&L, looks at a period of time. This can be a month, as you see here. It can be a year, it can be a quarter, it can be any period of time, but this is looking at a period of time, as opposed to the balance sheet, which looks at a single day in time. Okay, balance sheet used to tell you what the company is worth, and the income statement telling you whether or not the company is generating a profit or a loss. So this particular company, you can see, is generating a profit up here. So net income after taxes. So this is what's left. After they started with their revenues, you subtract out cost of goods sold. That's a term you would associate with the income statement. And after taxes, after they pay their creditors, the interest that's owed, remember that's a obligation they have. So you got to pay the creditors. Okay. Again, taxes, I mentioned that. this is net income after taxes and expenses. Okay, so the obligations, and then out of that, you can see here this company has chosen to pay a dividend. Remember, dividends are not mandatory, so the board here has elected to pay dividends, and they pay some of this $35 million out to their shareholders, not all of it, but they paid some to preferred, some to their common, leaving them with just a little bit over $33 million that they're going to keep or retain for themselves, retain in the company, retained earnings. This is earnings or profits the company had that they keep, okay, retained earnings. And you'll notice that on that balance sheet, if you look back there, look what you see here, retained earnings, right above the total net worth. Retained earnings is where that money that we just saw would get added to the existing retained earnings that we see there. Okay, all right, so you have balance sheet and income statement, which we use to measure the health of a specific company. Okay, now as far as taxation is concerned, we have different types of taxes. We have progressive taxes, and progressive taxes would be like the more you make, the more stuff that you own, the more you're supposed to pay. So examples of progressive taxes would be like an income tax or an estate tax. But then we have other taxes known as regressive taxes, and these are what are called flat taxes because everybody pays the same. So sales taxes would be an example here, and gas taxes. So regressive taxes are more punitive or harmful to people that are in lower income brackets because it might be a flat 1% tax that everybody pays, but if I'm in a lower income, that 1% of my income is going to hurt me more than 1% of your income if you're a millionaire. You're not going to feel that at all, but I'm going to notice it. So regressive taxes or flat taxes, more punitive to lower income individuals. Okay, now other types of income or ways that we can classify income. We talk about income being earned income if you actually worked for it, or you're getting an income stream from work that you did in the past, maybe royalty income perhaps, or you get a paycheck, or you're an hourly worker. The point is you get a paycheck for work that you did. That is taxed at what's called an ordinary income tax rate. Okay, whereas your portfolio, it can also earn money for you. Your stocks and bonds, generating dividend income, interest income, and that is also taxed like a paycheck, taxed as ordinary income. Now, bond or interest income gets taxed at the same ordinary income rate that your paycheck does, but your stock dividends, those actually get a favorable rate applied to them. So the rate would be capped there at 20% would be the maximum, but it is considered to be ordinary income. Just your stock dividends get taxed favorably. Okay, but think of it, it is a paycheck that comes to you while you own your stock. The interest income is the paycheck that your bonds are bringing home to you while you own them. Okay, so bond interest, depending on who your issuer is, will dictate whether you're going to pay tax on that interest income to the federal government and the state, or one or the other, or neither. So if you own a corporate bond, the interest income is taxable at the federal level, and it is taxable also at the state level. So out of that, on that interest income you're receiving off your corporate bond, you're going to pay taxes on that income to both federal and state. If you have a U.S. government form of debt, a bond, a note, a bill, the interest income, taxable only at the federal level. Remember, only the federal level, not at the state level. And then municipal debt, just the opposite. You will never pay tax to federal. You may or may not pay tax to the state. So municipal debt depends on who issued the debt and what state you're considered to be a resident in. If you want the most favorable tax treatment, or you want to recommend the most favorable type of municipal bond for a client, you need to know what state they're considered to be a resident in, and you want to keep them with an issuer, any municipal issuer, from their state of residence. It could be the state, the city, a county. Just keep them in their home state. That way the interest income not taxable by the federal government, and they would not pay tax to the state either. But so I happen to live in Arizona. If I buy a bond issued by the city of Los Angeles, I will not pay tax to the federal government on my interest income from that Los Angeles bond, but I will pay tax to the state of Arizona. It just makes sense, right? I live in Arizona. Why would I be lending my money to the city of Los Angeles? Okay, that's what the state of Arizona says. Maria, you should have lent your money to a municipality here in your home state. So that's the way that works. Now, if you invest in a U.S. territory or a bond that is issued by a U.S. territory, Guam, Puerto Rico, the Virgin Islands, there you don't even have to live in that territory, and you get the interest income tax-free both at the federal level and state level. So no taxes on the interest income in the case of a territory. So that's a handy little chart. So you might want to jot that down. And please remember that, again, as you're listening now to the recording, you can always pause these recordings. You can come back and listen again later. So if you didn't get it all down as we're going through it, you can always come back. All right, now income, the interest income, the dividend income is the paycheck that your securities bring to you while you own them. Capital gains and capital losses you can only get as a result of selling an investment. Okay, those are important. You don't want to confuse the terms income versus profit. Those are two different things altogether and different in the way that they're taxed. Income is taxed as ordinary income. Profit, your capital gains, are taxable as capital gains. Those come from when you sell your investment. You either made money, you profited, capital gain, or perhaps you lost money, capital loss. Okay, so if you have gains or losses when you sell an investment, how those get taxed depends on how long you owned your investment. If you own the investment 12 months or less, it's going to be considered a short-term capital gain or short-term capital loss. Now, losses are not taxable, but if you have a short-term capital gain, that gain will be taxed at your ordinary income rate. If, however, you own your investment more than 12 months, and please be careful here, notice that short-term, it's 12 months or less, not less than 12 months, 12 months or less, and long-term is more than 12 months, not 12 months or more. It is more than 12 months to get the long-term treatment. 12 months, exactly 12 months, that's going to be short-term. More than 12 months, those gains will get taxed favorably at the long-term capital gains rate, which you can see at the very maximum would be 20%. So someone who's in a 40% tax bracket, when they sell their investments and have profits or capital gains, the max they would pay would be 20%. Okay, so you definitely want to know the definition of short-term versus long-term. The holding periods, definitely testable. All right, here we have an example. I'm just going to run through this very quickly. Like I said, this can sometimes take people a little bit of time to kind of latch on to what's going on here. So again, you can always come back to it or pause the recording if you need to process what you're seeing. But here we're talking about Mr. E has income of $150,000, and he sold stock in 2019 and made $7,000 in capital gains. So those would be profits. Okay, he also had losses in the previous year, 2018, of $19,000, which he's carrying forward into 2018. Okay, so he had carry forward of $19,000, losses carry forward. He's got gains in 2019 of $7,000. Gains, of course, are taxable, right? But the thing is that when you have profits, gains, before you calculate the tax here, you are able to offset those gains with losses that were generated either in the current year which he doesn't have any losses for 2019. So any losses that we might be carrying forward, as he is here, 19,000, we can apply that against the gains, and he's got more than 7,000 in losses, so that will cancel out all of his gains. He won't have to report any gains or pay any taxes, I should say, for 2019, and he'll actually say he's got losses remaining of 12,000. Okay, so the gains have been canceled out by the losses, so no taxes on the gains. But he does have income. He made $150,000. That's earned income. That's a different tax altogether. So how much will he pay on, or how much income will he pay taxes on? Well, we say $150,000. Well, here's the other thing though, those losses. So he's got right now the 12,000 in losses that are still sitting there. He can actually use 3,000 of these losses to help reduce that income number. But 3,000 is the maximum they will allow anyone to apply. So you take the 150,000, subtract 3,000 from the loss bucket here that says he pays taxes on $147,000, and that will leave $9,000 in losses that he carries forward into 2020. Okay, so his loss bucket started off at 19,000. He used 7,000 from that bucket to cancel out these gains, and then 3,000 of what remained he applied against income and dropped his taxable income down to 147. But they will only let him apply 3,000. So the 12,000 remaining, that gets carried forward into 2020. Okay, and you can carry forward losses as long as you have them. You can carry whatever's left into the next year. Okay, so you can carry losses in forward indefinitely. Okay, so loss carry forward. All right, and then gifting. Gifting is when here we have someone that has securities. Here we have this woman wants to give her niece shares of stock. She's gifting them. And so you want to remember here, if you give someone a gift of securities, you also give them your cost basis. So when the niece goes to sell these shares, let's say she sells them for $90 a share, she's going to have a $60 tax consequence there, capital gain that she's going to have to pay taxes on when she sells those shares. Okay, so gifting, you give someone your cost basis along with the shares. But if the aunt, instead of making a gift while she was alive, she waits till she dies and then leaves her assets, her portfolio to the niece is happy, not because her aunt died, but because the securities receive a step up in basis as a result of her inheriting them. So step up in basis you're going to associate with inheritance. And so whatever the value of the securities was on the date of death, let's say at this example, $85 was the value of the stock on the death of the aunt. So that is what the niece gets in terms of a cost basis. The shares step up to $85. If she were to sell those shares for $90, then she would only pay tax on $5 of gains versus had she received them as a gift, remember she would have had a $60 tax consequence there if she had sold them for $90. Okay, so gifting, no step up. Inheritance, you get the step up in basis. And then the last thing we'll look at is annuities. We're not going to go deep into annuities here, so it might be an area that a lot of you have questions about, but we're just going to touch on some basic terminology here. Annuities are something that you'll see in some form or fashion on all these tests. The main thing to remember, first off, with an annuity is a retirement plan. Okay, and so think about what that means with any type of retirement plan. You have tax-deferred growth happening inside the retirement plan. So when that money that's been growing inside the retirement plan is finally distributed, it's going to be taxed, and it's going to be taxed as ordinary income. Don't ever pick capital gains tax consequences with any type of distribution from a retirement plan. So there's different ways you can take money out of an annuity. So let's say we put 10,000 of our own money into this annuity. That's what's called our cost basis. That's money that's already been taxed, so that will not get taxed again when it is distributed. So cost basis in an annuity, when it's distributed, is distributed tax-free because you've already paid taxes on it. Okay, we put 10,000 in to start off this annuity with. We leave it in there. It grows to be worth $25,000 over the course of time. So there is $15,000 worth of growth. As you can see here, the client wants to take a lump sum withdrawal. I just want to take all of it out in one chunk, cash the whole thing out, all $25,000. Okay, give me all $25,000. Well, remember, my cost basis, what I started with, does not get taxed when it is distributed. So subtract that out from the $25,000. That leaves that growth of $15,000, and that, as I just mentioned, since it's been growing tax deferred, is going to be taxed as ordinary income. Okay, ordinary income rates. Okay, don't ever pick capital gains taxation with distributions from any type of retirement plan. All right, so that's lump sum. So that could be, that's like getting a $15,000 paycheck. So if they have any other earned income, that could bump them easily into a higher tax bracket. So if the client says, well, I don't want to do that, I don't want to get bumped into a higher tax bracket, can I just pull out some of it? Well, yes, that's called a random withdrawal. So in this case, we're going to start with $15,000 cost basis. So again, that's money that's already been taxed. So it will not get taxed when it's distributed. Put it into the annuity. It's going to grow tax deferred, everything growing on top of the $15,000, never been taxed. So the value now is $35,000. So that's $20,000 worth of growth. That is all going to be taxable when it comes out. So since the government stands to benefit from you pulling out that $20,000, when you take random withdrawals, they're going to make you take the growth out first. It's what's called LIFO, last in, first out, LIFO tax treatment. So annuities, as you know, are life insurance vehicles, life insurance products, I should say more correctly, life insurance products. And so LIFO tax treatment, you're going to associate and only ever pick an answer that has to do with LIFO if they're talking about an annuity, a random withdrawal specifically. So investor here, so we got the $20,000 worth of growth. They want to pull out, let's say, $9,000. Okay, that's coming out of that growth, so it's all going to be taxed as ordinary income. All right, that leaves out of all that growth, remember that's all going to come out first. So $20,000 of growth, they pulled out $9,000, paid tax on it. That leaves $11,000 of growth still in there that has to come out. Okay, well, they come to you sometime down the road and say, I want to take another random withdrawal, but this time I want to take $12,000. Well, they've only got $11,000 of growth in there. So how can they pull out 12? Well, they pull out all the growth, pay tax on that, and then the other $1,000 that they want to take is going to come out of the cost basis. That does not get taxed, right? Remember, the cost basis is not taxed. So how much will they be taxed on? You need to look at basically just all of the growth. Anything that came out of growth is going to be taxed as ordinary income. So they would get taxed. Here they would have, the second scenario, they would have been taxed, you would have computed tax on $11,000. The other $1,000 is not taxed. Okay, so they often like to do that with random withdrawals, have the person taking a random withdrawal like this, where some of it will be taxable and some of it is a return of cost basis, and then ask you to calculate what the tax would be. So just be careful with that. Figure your growth first and just know that that's all going to come out, and it's got to come out first because of LIFO tax treatment. So that's going to conclude our discussion today. We don't have the ability to take questions on the recording, so we hope that you enjoyed the seminar and that you found it valuable. And check out all the others in the series. We have several other topics that you might find of interest. We thank you for choosing Kaplan, and have a wonderful rest of your day, evening, wherever you may be, and good luck on your exams.